a lot of uncertainty still in the market, but now that we hear the European Union could be giving Greece some kind of rescue package to try and ensure that the debt crisis does not spiral out of control. Now we're seeing markets slightly in the positive and a little bit of a rebound in the commodity space as well. What do you foresee happening in this space? Clearly it is about debt and ensuring that some kind of structure is put in place.
Yeah, look, I mean, markets are choppy because they're trying to find direction. And I mean, the Greek issue is one issue amongst many issues. I mean, other issues that are facing the globe at this stage is how quick will the recovery happen in the US? How quick will it happen in Europe as a general rule? And then if you look at the UK, how quick will recovery happen there? And it's really a focus away from G7 and into emerging markets and saying, well, if emerging markets are going to lead the charge as far as growth is concerned, well, what does that hold for the world? And remember that we're in uncharted territories as far as that's concerned, because emerging markets have never really led the charge as far as growth, GDP growth is concerned in the world. And it's all about that, and it's just uncertainty, you know, and that's why we've seen this progressive slow sell down in the market. And it's not a crash, it's just a slight slowdown, you know, in stock prices. They ran really hard last year, you know, from the bottom end, South Africa, bottom end of the market, you know, markets were up by 56%, you know, that's a fantastic number, you know, that's up to the end of December.
Do you think the slowdown is going to persist from these levels, Cobie, or do you think the markets are now looking to enter at these levels? You know,
that means I'm going to have to forecast, and you know, I'm very bad at forecasting. You know, invariably I'm going to get it wrong. So what I'd rather say is, you know, there's a whole bunch of companies out there that are selling at good value, and there's a whole bunch of companies that are dying to business with people in markets. Are you interested in buying those? And if you are interested in buying those, and if you are interested in holding on to those companies for the long term, that's the kind of opportunities you should be looking at taking. I mean, and a good indicator of this is by actually looking at returns in the markets over the last decade. Because I mean, we haven't spoken about the decade, and 2009 was really a close to the decade. And maybe it's a good time, you know, maybe just to reflect on that. You know, the decade held a couple of really negative returns. And 2008 was probably the very best of those. You know, market was down by minus 23% in 2008. The other two very big negative times in the market was in 2002, minus 8%, and that's on the back of those September the 11th attacks. And then because the NASDAQ bubble burst in the US and we saw markets selling down quite aggressively, the market did a fairly anemic 0.3% in 2000.
But for the whole decade, we've basically had a return of 16% per annum.
Absolutely, because, you know, as the market sells down, you know, people start pricing in future earnings again, and as the future earnings happen, the market continues to buy up and up and up and up. And there you can see the returns from 2004 onwards, and you can see how fantastic those returns are. Now, if you say to an average investor, look, I tell you what, I'm going to give you 16% per annum every year, and you don't have to, there's going to be no downside. It's only going to be 16% per annum. Well, all of a sudden, most people would be interested in that kind of investment. But it's because the equity markets are continuously trying to price in the future that you get these swings and roundabouts. It's what we're seeing right now, and that's what makes it unpalatable.
In March 2008, we hit 33,000 points on the JSE All Share. When do you see that happening again? I know you don't like forecasting, but do you think it's any time soon? Because clearly on the JSE, we're very close to that 30,000 level. The question is, what is going to push us higher from these levels?
Well, look at it from a price to earnings multiple. You know, during that time, the total price to earnings multiple for the market was sitting beyond 17. So let's call it 18. And if you look at the price to earnings multiple today for the market, it's pulled back from a 17 PE all the way back to a 16 and a 15.5 PE, which is slightly ahead of its long-term average. The only difference is that earnings are down 30% on the JSE. So if your earnings are down 30%, where do earnings go from here? Well, earnings have to pick up. Earnings have to at some point pick up. You know, I always say companies make a plan to make money. You know, that's why companies survive. They're not a bond. They don't behave like cash. They behave like companies because they have to generate the earnings.
And of course, cost cutting is one of those measures that most of these companies have embarked on. Looking at the likes of BHP Billiton, came out with robust results. Also, just keeping in mind it is a global company and it has its tentacles in a lot of different spaces on the planet as well. BHP Billiton 24% stronger than the previous quarter in terms of results, but also put out a little bit of a cautionary note saying we've got to keep in mind that things are still looking a little bit bleak for 2010. A lot of uncertainty right now.
Yeah, and it's a movement away from G7 and the focus on G7 back into emerging markets. You know, China is set to become the world's second largest economy this year, overtaking Japan. With that comes great opportunity, but with it also comes great uncertainty. And that is what BHP Billiton is talking about. Not only that, but also they're looking at the G7 recovery and saying, well, how quickly can this happen? Because remember, what they're doing is they're taking a cash pile and they're reinvesting that cash pile into new projects. And as the new projects come online and on stream, they wanting to generate a revenue out of that. And remember, there's base costs that you have to take into consideration. Take all this into consideration. Now, BHP is saying it's uncertain, but it could turn around quite quickly. But it could also lag quite for quite a long period of time.
Cobie, we had the jobless rates in South Africa dipping to 24.3% from 24.5%, the data that came out yesterday. So hopeful that we had a little bit of a surprise to the downside on that figure. But clearly unemployment is still one of the big issues here in South Africa, and with that strong rand, we are expecting more job losses, at least in the manufacturing side of things. This is also going to be quite elemental in terms of the recovery in South Africa, and also for earnings to recover substantially.
Yeah, unfortunately, that goes hand in hand with the skill shortage in this country. The higher skilled your labour force is, the more easily they keep long-term jobs. Whereas in South Africa, we just don't have that situation. That's why our jobless numbers look so different to, say, for instance, G7 and G7 type countries. Yes, you need employment to have a full recovery in South Africa. If you look at manufacturing is starting to turn the corner, and it's starting to increase again and accelerate. And with that, it should drag the unemployment numbers, down from the 25.3% level that we're seeing at the moment. The point is, when you look at unemployment numbers, is we've turned the cusp, and we're sitting at the cusp of a very high rate, and it's trying to drop down the other side, which is basically and invariably also the situation that you're seeing right across the globe with other people's unemployment numbers, barring China, obviously, which hasn't got an unemployment problem at this stage.